Jenny Brown. Welcome to this week's MFB news and welcome to my new house. We got there in the end, 7 months in the making. We're absolutely delighted to have moved in over the weekend. 7 months in the making, and it will take us at least that time again, I'm sure, to unpack the millions of moving boxes that we have in the house. Don't be fooled by what appears to be an element of kind of calm organisation behind me. The rest of the house is absolute carnage. On that note, actually, apologies if this video is a bit rough around the edges. I haven't actually managed to unpack my office yet, so the kind of setup that I have and the technology that I have to record these videos is all put away at the moment, so we'll be back to normal next week. But just for now, we're going to make the best we can of the situation. I didn't want to not do a video simply because I've moved house. That felt like a bit of a cop-out, so we're going to do our very best this week and keep our fingers crossed. Now, in terms of what we've got for you this week, we've got some repricing just to cover off. Some lenders have priced up, some have priced down. What we've also seen, which is quite interesting, is some changes in criteria from a few lenders. And some of the things that they've kind of done really kind of made me think, actually, you wouldn't necessarily know as a borrower this criteria even exists. So I'm just going to run through that in a bit more detail. I think that's really interesting. And then finally, what we're going to do is just talk a bit about what's going on with inflation and how that's going to impact interest rates going forward. So hopefully some great content for you this week. Okay, so first of all, let's talk about what's been pulled from the market or has gone up. So Vida Home Loans have withdrawn some of their limited edition products. Now, limited edition products is where a lender brings out a product which is an addition to their kind of standard product set, and they will say, well, okay, this product is probably more competitive than our other kind of standard rates. It's going to be available for a period of time, and once it's ended, it's gone, it's going to be withdrawn, and there's no more funds available on this product. It's a bit like a flash sale, for want of a better description. Now, lenders will often bring these rates out if they want to kind of bring in a quick snap of new business, new applications. So we saw a lot of lenders bringing these out towards the end of last year. Obviously, things towards Christmas got quite quiet because of the seasonality and also because of the COVID regulations and all the rest of it. So we saw quite a lot of lenders bringing out these last minute sort of limited edition products. We're slowly seeing them starting to pull them again now. So Vida are the first lender who have done this. We've also seen Foundation Home Loans withdraw their limited edition products as well. What does this mean? I mean, basically, what you're left with is less competitive products for all intents and purposes in the main. So, you know, if there is a product which you've seen which is advertised as being a limited edition, always the best advice here is just to get in and get it secured, because lenders don't provide brokers with notice in terms of when these are going to be withdrawn. They just tend to pull the plug on them. Some lenders are quite gracious and give the brokers maybe 24, 48 hours notice. Others literally get an email at 4:45 in the evening saying it's going at 5 o'clock and there's nothing we can do. So yeah, time is of the essence if you've seen a limited edition product that you'd like to have your eyes on. Now, also, we've seen BM Solutions make increases to their rates, and Natwest have done the same thing to a dozen of their rates. The increased pricing is not massive, circa 5 basis points. It all makes a difference. Obviously, we don't want to be borrowing at a rate that's higher than is absolutely necessary, but the direction of travel for pricing for those guys has most certainly been upwards in the last week. Now, to complement, I guess, the increases that we've seen from a couple of lenders, we've also seen some lenders bring some rates down, conversely. So Coventry Building Society have reduced their standard 2 and 5 year buy-to-let rates by up to 44 basis points, 0.44. So that's quite a lumpy reduction, actually. They've also reduced their 2 and 5 year fixed rate portfolio products. So these are for landlords with larger portfolios, between 70 and 75% loan to value by up to 60 basis points. So really kind of slashing prices here. The Coventry as a lender, I mean, I say this every time, I genuinely really like them. They're a lender who lends only to individuals. There's no limited companies. They're not looking for anything racy in terms of the property type. But what they do really, really well. There's no minimum income requirement. They're happy with older applicants. You can have up to 10 mortgage buy-to-let properties in your own name, unlimited properties in limited companies. And their rates are really good. I think what happened is they're a lender who prides themselves on having incredibly good service. So what I suspect happened is in the run up to Christmas, they got super busy, pushed their pricing up just to kind of slow pricing down, so get themselves out of the kind of the cheaper rates. dumb down the level of business that they're getting in to really kind of get on top of their service levels. Because like I say, they're one of those lenders where if they're running slow because they're really busy, it mortifies them. Other lenders, it's quite interesting, actually couldn't care less. But these are one of the guys who really do pride themselves on having an incredible service. So they've pushed their pricing up, slowed the business down, things have quietened down again, they're back up to speed, so they brought out some new rates which are really, really lovely. We've also seen Virgin Money reduce some of their products as well on their portfolio landlord products and non-portfolio landlord products. Reductions of up to 14 basis points, so not quite as generous as the Coventry, but likewise another lender who had pushed their rates up previously and now easing them back down. I really wouldn't take these rates coming down as a kind of sign that actually mortgage interest rates aren't actually going up in the round. These are lenders that are actually kind of just going back to or compensating for large increases they made previously where they'd got super busy. My friends at Natwest have made some changes to their lending criteria, and they are never one to not simplify something which could be very, very straightforward when it comes to buy-to-lets. So what it looks like Natwest have done, reading their email, and if I actually read the email out to you, you'd be thinking, good God, what on earth does that actually mean? They don't word things particularly clearly. But what they essentially are talking about is they've changed the rental calculation that they're using when they're assessing affordability on buy-to-lets. So what they're doing is they have one calculation for landlords with smaller portfolios, so up to it'd be 1 to 3 properties, and then a separate calculation for those landlords with 4 or more properties. Now, what they don't tell me is what that calculation is, which is really helpful, but I'm pretty confident in assuming that the more onerous calculation, the more restrictive one will be for portfolio landlords. Now, what they've also said they're doing is bringing in a lower rental calculation on like-for-like remortgages and 5-year fixed rates. And this is the bit that kind of sparked my interest, and I thought actually I should probably talk to you guys a bit more about this. So when lenders are assessing how much they're going to lend to you on a buy-to-let mortgage, generally speaking, they're looking at the rental income, and there's a calculation that they do which does vary between lenders, between ownership structures, between the type of product you're going for, and also the type of property that you're lending on as well. So there's many, many permutations of this, but fundamentally every lender is taking the rental income, doing a calculation to it, and this determines whether the mortgage that you're looking for is affordable or not. Now, what we have found in times gone by is that some people, particularly when they own a property personally, have been struggling on the rental calculation because that is quite onerous, whereas in limited companies, it's more generous. And what lenders are doing, or some lenders are doing now, is saying, well, actually, if we're doing a remortgage, you've already got the mortgage with someone else, and you're not looking to borrow any more money, you're simply replacing your existing debt on the same basis, but with us to get a better interest rate. We're going to give you a more generous rental calculation than we would if you came to us and were saying, I want to remortgage and borrow more money, or I'm buying somewhere. Because actually what you've done historically is you've serviced that debt quite comfortably. The whole point of the remortgage would be to save yourself money. Therefore, why would they not be willing to take this on or be more open to taking it on than if it was not that situation? So Natwest are now adopting this approach. So if it's a like-for-like remortgage, they are offering a slightly more generous rental calculation. There are other lenders that do this, the Mortgage Works, BM Solutions, Virgin Money, just to name a couple. But you know, this is great to see Natwest really revisiting things. Now, the other thing they're doing is also bringing in a lower calculation or more generous calculation if you're taking a 5-year fixed rate. Again, this is not new to the market. Lots of lenders already do this. So essentially, if you take a 5-year fixed rate, the rental calculation is more generous than if you were taking a 2-year fix, a 3-year fix, or a variable rate product. Why is that? And I think this is also quite interesting. The reason that lenders can be more generous on 5-year fixed rates, and this is all under sort of regulation, is that if you take a mortgage today over a 5-year period, the first thing that can happen is that interest rates can move adversely, so they can go up. The other thing that would happen is that the amount of rent that you receive, in theory, over a 5-year period should also go up. So if you're taking a 5-year fixed rate, what you do is you hedge yourself, you shield yourself from interest rate fluctuations, but what you also will experience in theory is an increase in the rental income. So the amount of surplus rent you should have each month over the 5-year period should grow. So what the kind of theory here is that if you take a 5-year fixed rate, then you should be able to borrow more because you're protected against these kind of variations in the background. So there you go, a little lesson on rental calculations. Like I say, it's really, really complicated. Every lender has a different calculation for different types of products. So if you ever wanted to just find out how much you can borrow based on the rent, honestly, the best thing to do is either give us a call and we can run through it with you, or there's calculators on our website that are really, really good. Okay, so sticking back to Natwest now, so what they're saying is that they brought these changes in to really so people can borrow more money with them, essentially. I suspect what's happening is they're looking at their proposition, realising they're a bit out of kilter with the rest of the market. What can we do to make ourselves more competitive and bring in more business? These are some tweaks that we can make that we're quite comfortable with. Now, what they're saying is that they don't have a minimum income requirement to have a mortgage with Natwest. And if the rental calculation, whichever one it ultimately ends up being, works, they're not going to be asking for proof of income on the application. However, if the rental income is not working on the standard calculation, what they can then do is start to factor in disposable income. Now, this is also known as top slicing or income-backed buy-to-let mortgages. So the rental income isn't working, but hang on a minute, you have £3,000 worth of disposable income every single month from your day job. Actually, you can really afford to cover this shortfall nonetheless, so we'll lend to you anyway. So if you fall into that count with NatWest, they are going to want proof of income. But like I say, there's no minimum income requirement. So there you go, some changes from NatWest this week in terms of criteria. Right, now for some green mortgage stuff. So Barclays have launched some green buy-to-let products which are a bit cheaper, which is very in keeping with what everyone else is doing, a bit cheaper than their non-green products. Green mortgages are available on properties with an EPC rating between A and C. Now, interestingly, I'm not that keen on this, I have to be honest with you. What they're saying is that the property to be eligible for the green products has to have been bought from a property developer or builder and have an energy efficiency rating of 81 or higher, or an energy efficiency band of A or B. Now, what I don't take exception to is the requirement for the actual energy efficiency of the property or the rating. But what I do find slightly interesting is that what they're essentially doing is only offering green mortgages on new build properties. Now, the green proposition in the market at the moment is a bit of a funny one, because different lenders are just, well, everyone's trying to feel their way through this and try and do something that's good and meaningful. To my mind, actually, in this country, what we need to be doing is not just building lots of green properties. What we need to be doing is taking the existing housing stock and improving the quality of that. And so I don't feel that this mortgage really hits the mark. Now, lots of lenders are saying if you buy a property and if the EPC rating is A to C, it doesn't matter whether it's a new build or not. Actually, we're happy to acknowledge that it's a green property. We'll give you the better deals. Some lenders are actually only offering green rates where properties are over a certain age and also fitting with the A to C EPC rating. So everyone's taking their own approach. But really, I suppose, just to highlight the fact that Barclays have brought out a green offering, it's really commendable that they're even thinking about this. So well done, Barclays, for having a good first go at it. But actually, I think that realistically what we need to be doing as a kind of community of investors is really thinking about how we drive up and improve the existing housing stock rather than simply rewarding people for buying a brand new property. Now, I'm sure you would have seen lots of commentary in the news about inflation, and if you haven't seen it in the news, you probably felt it when you've gone to do your food shopping or fill up your car with petrol. So it feels really pertinent, actually. We just talked briefly about inflation and what people think this is going to do to interest rates as well. So look, here's some data for you. On a monthly basis, CPI increased by 0.5% in December. CPIH inflation, which is a number which includes owner-occupier housing costs, rose by 4.8% in the year. Now, the biggest contributor to that rise was household services, so gas and electricity, and also petrol as well. But on the back of this, economists are now predicting that multiple interest rate rises may be necessary in the year ahead. Now, as you will recall, the Bank of England increased interest rates in December, which some people thought was a bad decision because there was a lot of Omicron uncertainty at the time. Obviously, it's Christmas. But look, they've made their decision nonetheless, and there is expectation that they will go up again in February when they meet early in the month. Now, for the MPC, it's a really difficult decision and almost trade-off between ensuring financial stability and also then ensuring or helping households cope with the cost of living going up so dramatically. So that's going to be a really difficult decision for these guys. But ultimately, that is a decision they have to make. Now, in terms of what's happening with inflation and what the predictions are saying in the sort of longer term, the expectation is that inflation is going to peak in the second quarter of this year before settling down in the latter stages of 2022 and early 2023. So these increasing costs that we're witnessing at the moment, we're expecting that to continue for a period of time, plateau probably somewhere in sort of May time, and then really start to ease off throughout the rest of the year. So I think it's time to really buckle your seatbelts. I think things are going to get worse before they get better here. But also the expectations that interest rates are going to go up. Now, if you are on a fixed rate, don't worry, that means that you're actually shielded from this for the time being. So that's some very good news there. Those people who are on tracker rate mortgages are going to really feel the force of this, and also those on variable rates as well. So what can I say? Is there a better time to really think about locking in onto new fixed rates? Probably not at the moment. Likewise, if you've got a fixed rate, realistically ending any time before August of this year. Obviously, if interest rates go up over the coming 7 months, the costs of borrowing are going to go up as well in terms of what the rates lenders charge. So the rates that you would take if you applied for a mortgage in July are going to be more expensive than if you apply for them now. The message is very clear, the writing is very much on the wall. If you are going to be in the market for a mortgage over the coming sort of 7 months, now is the time to lock in and secure something at today's pricing. And that is everything for us this week. Thank you, as always, for your time. We genuinely really appreciate you having a watch and, seeing what we've got to say. Hopefully, it will be business as usual next week. I'll be back in a better setup. The sound quality will be better, the lighting will be better, and all that kind of stuff. But hopefully, there were some things really interesting, even if the overall kind of presentation of this wasn't particularly wonderful. Having said that, next week I should be in the purple room, so the presentation might not be too good then. Anyway, let's see how we go. If you have any questions, as always, 0345 345 6788. We'd love to chat to you or have a look at our website. And until next week, do have a really nice weekend. Look after yourselves. And I'll see you next week.